All right, we have our tools, our trading concepts, and let's prepare to get ready to find our opportunities. So, trading day prep begins after the day's market close. So, as swing traders, while we're not focused on sitting in front of our screens all day, if you have a full-time job, which is just all well and good, and swing trading is fabulous for that, where at the end of the day, after dinner, after some relaxation, we can sit down and start going through our scans and looking at what's happened in the broader markets and sectors and stocks, as previously explained. We can monitor news and what was moving, what has affected our positions, and looking for new trading opportunities. We go through the charts, we close some trades, we complete our trading diary, good trades, bad trades, and so on. What happened, maybe making a audio recording while you're capturing a chart. That's what I'm showing you here, whereas you can have a chart and Microsoft OneNote, you could be capturing your screen and talking about it and keeping that as reference to part of your trading journal and referring back to it at another time. As that's your review of your trades. Your watch list. Is there something on that watch list that you want to include for the next day? You're looking at multiple time frames, and as we just talked about, the broader markets, those sectors, market internals, set alerts. Use your computer to your advantage to where you're getting an alert, and obviously these can be connected to your phone today, or even sending yourself an email to pay attention that an event has happened. So you're beginning your search. At the end of the day, as you're looking at the broader markets, as we just previously reviewed, and as to what you're going to focus on, you can review your universe. So in other words, you could take a particular group of stocks or several stocks that you have determined to be your universe. And what you could do with this software that I've already showed you is you could create a scan that says, look, I'm interested in stocks that are between $5 and $25. Just giving you an example. You could say I'm interested in stocks between $10 and $100, or whatever it is that you decide. And within that price range, I want those stocks to be trading at a minimum of 500,000, you might say 1 million shares, over a period of the last 30 days. And that would, if you were to just say stocks between 10 and 100 that are trading at least 1 million shares over the course of a 30-day average, you'd probably knock down thousands of stocks to below 1,000 easily. So you can decide, where you would want to focus your list and make your own universe of stocks. You're looking at the sectors of interest as explained and particular stocks. You divide your list down into your best ideas, either long or short. You'll check earnings dates, of course. And when I say sector generals, that means the big stocks that are being focused on by institutions. Everybody, of course, is going to pay attention to when Amazon reports, when Facebook reports, when Apple reports, when Netflix reports, and so on. So while you may not be in them, your stock that you're holding may be affected by that. So just be aware. You may want to raise your stop at that point, or maybe even put an order in to sell above current prices where you're anticipating that prices might move up. Economic reports that come out, you may decide that there's a big economic report coming out at 10 o'clock, so you're going to wait till after 10 o'clock to put in an order, even if it triggers above a certain price level or below. You can set up a screen like this where you have all of your ETFs set up, and it may take a couple of pages to do that unless you have pretty small charts. But what it enables you to do by setting up these pages is just click on that particular tab in the platform. And of course, you could set this up. You might be using eSignal or TradeStation or Thinkorswim, which Thinkorswim doesn't have such good charts, but it's great program for options. But in any event, you can set up a page with your different ETFs where you just click on that page and they all come up at the same time, and you can instantaneously look at all of these different ETFs and say, hey, this looks like there's a pullback in a particular ETF, or this one's in a downtrend, this one's in an uptrend. I'm going to stay away from this one, but this one has opportunities. And one of the great things about this platform, and I don't know, I think it's this here, I think it's that particular little icon there, that if you click it, it'll automatically open up the list of stocks within that particular sector. So pretty cool feature to be able to zero in, and it'll open it up right on that page, and then you could link a chart to that particular miner on that page, and you could start scanning through that. So it enables you to go through things pretty quickly. So here we have what you'd be looking for. Right, MasterTrader buy and sell setups, a gap list, which we created scans for that. We can, even if you're not trading gaps intraday, a gap list is a pretty good place to start looking for new opportunities, even for swing trades. As we looked at some examples, some of those professional gaps were great starting points to a move. So reviewing a gap list, we can review big volume spikes, breakouts, breakdowns, wide range bars, bottoming tails, topping tails, shakeouts, climactics. If you can see it on a chart, odds are you can scan for it. Once you've scanned for it, you then begin to cherry pick, meaning as the scan brings things down to a workable level where it eliminates what you don't want to see. And then we start looking at multiple time frames. We look for, as I explained to you, how the pattern forms. Is it erratic? Is it tight? Is it whippy? Is it near support? Is it showing relative strength and weakness, or moving averages that speed up the analysis? Is there a void? You're going to know, is it going to report earnings? Your volume part of your scan should have eliminated the low volume ones, but so I'm pointing out what you need to pay attention to. Your market internals, are they set up saying, hey, I've got this long setup here to buy a breakout, but my market internals are at a bearish extreme, and the broader markets have already run up 5 days in a row, and this stock is now going to break out of a consolidation? Historically, that doesn't work. Maybe it's on its own page and it can fight the historical norm, but the odds are against you, and our whole focus here and objective is to put the odds in our favor. And this is that same page that I showed you before, where you have stocks in the ETF that are linked, and as you click on those particular ETFs or the broader market, it's going to fill that particular minder in with the information that you put in that particular minder. And then you start going through and looking at the charts. I'm looking at my daily with my 20, 50, and 200. I've got my weekly on there, 20 MA, which I've already told you is what the 100 MA is. You don't have to put the 100 on your daily chart. And as I click on each one of those symbols in the stock minder, it's going to populate those two charts. And as I hit the down arrow button or the space bar on this platform, it's going to populate the next stock. And I'm just going to go through them. As you get used to doing this and you hit that space bar and it fills in the chart, you're going to look at those two charts in probably 2 seconds and know whether you're going to look at it a little further or not. So what we see right here on these charts right now is something I'd pay attention to, because I've got a pullback to a rising 20 MA, bullish alignment of moving averages with a weekly uptrend, and the last bar on the chart was a gap down to the area of that prior bar 2 bars ago, and it rallied back up to the high of the day. So that particular scenario is one in which I want to pay attention to and buy that above the high of that bar, looking for prices to move up to make new highs. So here is another screen that I utilize that scans for different candle patterns. So bullish wide range bars, 180 bullish reversals, bottoming tails, bearish wide range bars, topping tails, bearish 180s, and range expansions. So I can sort this by what's active, volume. I can put different criteria in these minders. But what I do is, these simple minders or simple scans, I just start looking through the active ones. And as I click on any of those symbols, it populates the two charts, and I start my scanning process to cherry pick the stocks that I'm focused on. And as already mentioned, our primary focus is to trade in the direction of the trend at the appropriate moment. And this software helps us find those opportunities relatively quickly. And that's what we want. This is my internals page. Obviously, it looks different than what I showed you in the prior section, but this is how we can set it up in TC2000. The McClellan oscillator or breadth on the upper left, the put-call ratio in the middle on the top, and quickly looking at the broader markets on here, and volatility index, which is a measure of anticipated volatility where our focus is whether it's at a prior low. Prior lows do not mean short the market. It can stay low, but our primary focus with volatility, the VIX index, is when it reaches a prior high or a high extreme, which is associated with a market bottom. Earnings dates. If you don't have the TC2000 platform, which would give you the earnings date, you go to Yahoo and look up the earnings date, and right there, save the page. You should have it in one of your saved pages to go to during earnings season. And anytime you're going to trade any stock, you should be checking to make sure that it's not going to report earnings, because earnings season happens over a course of weeks, and you don't want to be blindsided by buying something or owning a particular stock and then having a negative surprise. It's nice when it happens in the other direction, but that is not professional to be owning a particular stock and not being aware of when it's going to report earnings. Econo Day is another site where you can go to, and it gives you all the economic reports on any given day that are coming out pre-market or at 10 or 10:30. You may be aware of that, especially like on this particular day, the petroleum status report was coming out at 10:30. Well, if you own oil stocks, it's going to affect them, so you would want to know that. Housing reports going to affect housing stocks, obviously, and construction stocks. You should be aware of that. So just taking a look at this takes a matter of seconds to just be aware, and you're making educated decisions as to the information that's coming. This is a yearly chart of the Dow, as you can see, and I provide this to put the market in perspective. Now, we don't trade the yearly chart, but knowing what the market is doing long term, or even a sector, puts it in perspective of this market is going up essentially almost forever. And while I can't assume it's going to go up forever, and I think it will, honestly, but there's going to be corrections along the way. That doesn't mean we don't want to be aware, based on our market internals, especially like the yield curve reaching a bearish level, that the market is likely to go through a pretty severe correction percentage-wise. But as you can see here, the market has been trending higher. Now, I wasn't around in 1929, but we all know about the big crash and how much this went down from around 300 down to looks like around 10 or 20, whatever that might be. And then, but you can see here that the patterns are exactly the same, even from a yearly chart perspective, where there's wide range bars and bottoming tails and 180 reversals that you can see in 1974. And in 1982, there was a bottoming tail bar that took out the prior year's low and turned back up again. 1987 crash was, where's the crash? Of course, it was a big move percentage-wise, but in the perspective of a yearly time frame, it looks like nothing happened. 1995 was the continuation of the uptrend after a consolidation that went on for about a year. You can see the narrow range bar that preceded the wide range bar in 1995. 2000 was where the yield curve inverted, and there was a big bear market that took the NASDAQ down about 90% at the time. So it was a big move, and even though this uptrend has been intact for many, many, many years, the devastation that can happen to a portfolio over the course of a couple of years or even 1 year can be tremendous. And as far as an individual stock goes, some of them never came back. So it's something to take seriously, but I certainly wanted to put in perspective from a long-term point of view of what's happened here as a view of the Dow Industrials. And there was a big bear market in 2008 that bottomed out in 2009, and you can see the big bottoming tail bar, and then you can see how the advance continued from there. So looking at this chart at the end of each year to see what's happening from that long time point of view, why not? It's just a matter of pressing a button and taking a look. So why not? Look at the yearly chart. You can look at a quarterly chart. You can look at the monthly chart. And this is part of our top-down approach of seeing things from a very long-term perspective and then putting it in perspective of the shorter time frames. And as we're interested in here, from a swing trading point of view. And so our long-term view of being up and then assessing what's happening in our market internals, and is there risk growing for longs? Is there opportunity growing for those longs at the appropriate time? And so hope you've enjoyed this, and let's move on to our next section. One last slide just to review here what I've already said you need to be doing, viewing those longer term charts and internals and stocks and your trading diary. Of course, that's where you're going to find out what you're doing right from a technical point of view, what you're doing wrong. The consistency comes from finding out what you're doing wrong by keeping that journal and then stop doing it. Right? And that's part of the homework. And of course, take some time to relax. I know from my own experiences, when you're starting out in the markets, you are trying to learn so much so fast that it becomes consuming. You have to force yourself at times to step away and say, relax and smell the roses, spend some time with the family. I was certainly guilty of that, of just spending every waking hour to devour as much information as possible. We do come to the markets, most of us, after another profession. Very few get started as you might in going to college. But it's a great thing to be sharing this kind of information with your kids. So, and I've got plenty of subscribers that do that. Now, getting a 20-year-old to pay attention to what the stock market is probably going to be difficult, but the information is there to share. And if they learn this stuff at an early age, well, don't we wish that we all paid attention to this kind of information at that age? It would have been a great thing. So let's move on to the next section. This section is going to be more or less a review of everything that we've talked about, but repetition is fantastic, and looking at the setups again, and as I'll explain them to you, just help reinforce everything that you've learned so far. So let's continue. As swing trading and what we're reviewing, I'm going to assume that we've already gone through and reviewed the broader markets, sectors, and stocks. That's done. So we have our bias and we're ready. Go through and formulate our entry points and look at our swing trades. We'll review those foundational setups and patterns, and we'll review the components of those patterns and put them in the context of how it formed in that big picture. Again, this is what we've been talking about throughout the course. And as we cover those in those individual parts, I'm going to explain that all together in the chart examples. When we look at breakouts and breakdowns, right, this is a concept that many just don't get. I can remember years ago doing one of the trading challenges, and a fella that was trading there was selling software packages that the essence of it was to trade the novice breakout, meaning it was moving from a low all the way back above the prior high rather than buying the pullback. His entry points were here, and while that can actually work out, if your stop is down here, it should never go down there. But this particular individual, where he was selling his software packages that showed where these things did work, his stops were here, which was just silly in my point of view, because that's just not what we do. It's a novice play. What we look for is breakouts to occur where there has been some consolidation just prior to the breakout. In other words, there's been this shallow pullback, this refusal to go down here, and then we are buying the breakout. Or if we've missed that and it breaks out, we look to buy the pullback toward what was resistance becoming support. Common sense. Why would I buy something that's moved already greater than 100% from the bottom of the base to above the top of the base? Doesn't make any sense to me to be buying at that point, when if this is what happened and I recognize this as a break above these highs, what we're going to do as master traders is then wait to see if you get the pullback to support or a bullish consolidation that creates a support level, and then get the entry point from there. And you might be saying, well, Greg, what if it just takes off and just keeps going higher? So be it. It's not my money. That's not part of my plan. It's either going to do this, or I'm not going to participate. That's the discipline. I'll just move on to something else. I don't need to take on this trade, right? And because I don't want to put my stop way down here. It's either going to give me a secondary piece of confirming information, bullish or bearish, or I'm not going to participate in it. Retracements and pullbacks from breakouts, those are foundational entry points for us as swing traders. Meaning what I'm looking for is pullbacks to minor support, pullbacks that go all the way down to major support, can be traded under the proper scenario, meaning higher time frame. Our macro time frame is in an uptrend, bar by bar analysis supporting that buyers are stepping up, little breakdown failures, or even a W bottom. Within that retest pattern, you've got the tools. Use them intelligently. And breakouts, support being created, and you just look for your candles that are forming there, little downside shakeouts and bottoming tails and 180 reversals, red bars ignored. You've got the tools at this point to recognize what's happening. You're going to look, is there a price void over to the left? You looked at the broader markets. You're putting the odds in your favor. And the same thing on the short side. What was support will become resistance, minor resistance, consolidations. Is there a void? Factory work. You've got the method. You've got the process. Just repeat. If it doesn't set up, you don't do anything. We've already covered this, but review is great. Here we've got different patterns that we are looking for our bullish setups, and just turn them upside down for the bearish setups. As tracement and reversal, A red bar ignored, that's a continuation type of pattern. A little breakdown failure, and in this case the way I've created this is you've got a big wide range green bar around the red bar. And again, repeating, these are bullish setups, which by definition mean they're in uptrends or they're at some support or they're bottoming, and the macro time frames are pointing up. So I repeat that because I know those that are new, where you're trying to assimilate this information, at times forget different concepts. So if I keep repeating them, it's so that they become ingrained in your thought process. And by you practicing and repeating, it'll become ingrained in your thought process, and you remember the different components of our method and putting it all together. Whatever you call it, it's going up. Putting that together, you know that the 3-bar reversal is the same as a 1-bar reversal. We've just expanded the data. Failed sell setup, that's not a real sell setup because we're assuming it's in an uptrend, correct? We said that these are long setups, so that this reversal, the red bar at that time, while it does suggest it should go down, it should turn into be a red bar ignored. 180 reversal, well, we've condensed the data a bit from the one directly to the left, and it means the same thing as the bottoming tail bar. 1, 2, 3 continuation pattern, so a wide range bar up creates a price void. The inside bar builds up a little consolidation on the base, and we get a continuation to the upside. And while I don't have it drawn here, remember, is there a volume spike there? Secondary piece of information, but good information when it happens. W bottom, a retest pattern, one of my favorites, where we get a reversal, prices move up, they come back down to retest, buyers step up again. In this case, we've got a wide range bar. Great setup. So we've got 4 foundational patterns, many different variations, but bar by bar analysis enables you to recognize anything that's happening at the time. We don't need to have a specific pattern to say that this is what has to happen. Bar by bar analysis and alignment, which are multiple time frames and trend, are going to tell you what's happening. So the thing is to understand that you have normal type of retracement patterns, you've got retest and failure patterns. Flag patterns are one in which they're creating support or creating resistance. A well-developed base is one in which there's a longer consolidation. And one of the tools that we talked about was this longer consolidation in an uptrend where it gets far from the 20, catches up, or the 20 catches up with prices, where you've got this longer consolidation. Or if it's in a downtrend and prices have moved down rapidly, the 20 MA is caught up with prices, and that then suggesting a continuation of the trend. And of course, you're looking to see what's to the left. Is there a void? Shock patterns. We've looked at a lot of these already. I've shown you a lot. So this is to reinforce what you've already learned. Shakeouts, where you've gotten a consolidation and then you get a break to the downside and it immediately reverses back up again and goes sideways at that resistance. That's a bullish shakeout type of failure pattern. And this is a variation where now instead of a reversal red bar, you've got this topping tail bar, right? The top side shakeout or bearish shakeout. This one would be the bullish shakeout, and then the same sideways consolidation, and then we look for the continuation lower. Breakout bar failure, where we've gotten wide range bar breaking out above a few highs, get an inside bar, and then it breaks below the low. So if we're long and this happens, we exit below the low of that bar, not go short unless this was in a downtrend. It was in a downtrend and we got the breakout bar failure, we then could go short that type of setup. Breakout failure, topping tail, it's just a different variation. Here we're compressing the data. It's to understand that different pictures mean the same thing. We need to go back to the candlestick section, multiple time frame section, review it, and you'll see how we're repeating this information in different pictures, in different ways, but we understand what's happening and how to use it. A breakdown failure here. We've gotten a breakdown here. We've got a shock pattern where it attempted to go down and a 180 right back up again. It should go up. If it goes sideways and it turns into a variation of a shakeout pattern, that's okay. I understand all of this. This bar by bar analysis tells me that these things can form in different ways. However it forms, I understand what's going on here and how to take advantage of it. Here we have M tops and W bottoms. These form in different ways as well. Now, this M top, if it's a climactic kind of pattern, let's say that the weekly has become climactic and this is a wide range bar on the weekly time frame. Multiple bars moving up. It's a wide range bar. And now on the daily time frame, I've gotten this type of pattern, which could be 2 bars going side by side on the weekly time frame. So at times where we drill down, right, the daily is our primary time frame, but we've gotten a bias from the weekly, and this pattern could provide us an entry point to sell short. This one, not so attractive under that scenario, but pointing out the differences here. It's the opposite. On the downside here, this could be a climactic move lower or a wide range bar to the downside. On the weekly, ending the move, and then on the daily time frame, we're getting this W pattern. In addition, this certainly could be in an uptrend. This could be happening in an uptrend where we're getting a W pattern within a price void. So there's a sharp move up, and then a pullback and creating support. This M top that we have right here is one in which it was a deep pullback. So we've got a breakout and a deep pullback into support and then a retest. Now, in this situation, we're kind of getting a pattern here that's giving us a warning that distribution is happening. This could be in an uptrend, and this is the kind of pattern that we really don't want to see. A combination of a breakout failure and a deep pullback and then a retest with a topping tail and a bearish bar. All of that giving us a warning that the trend is beginning to deteriorate, and is just the opposite if it was in a downtrend. As we look at these charts that we're going to review, we're going to be looking at the daily time frame, and I'm going to explain it from the point of view that we already have looked at multiple time frames. And it says it means that there's a void. We've considered relative strength and relative weakness. We've looked at the broader markets, whether they're extended or not. It may be extended on the daily, right? That may be getting started as an M or a W. And we're looking at these daily setups, whether they're at support, can that been taken, right? From a weekly time frame, is it extended? Everything that we're talking about, we're going to be bringing this together and looking at these patterns to reinforce what you've already repetition. And this is what you'll find the coaching sessions are about when we do them. You will benefit tremendously from when we do an MT Live, because you're familiar with the concepts. So they're not going to be when you're hearing them the first time. And all of this reinforces what you've learned to where, you know, the idea is for it to become second nature for you, right? And that's what it says, key to success. So in this example, we've got a nice uptrend, and what should be jumping out at you here is this nice bullish consolidation into a rising 20 MA, which should be telling you pay attention. I'll just point out a few things here. You know, volume bar spike that didn't follow through. We don't know it isn't going to follow through at that moment. We know after the fact that it didn't. Volume spike on the way up. Power move up. Look at the flat 20 MA, close to the 50 MA. The move is just getting started. This turned out to be just a very long consolidation. bullish move starting again, volume. Now this is an interesting concept here that we really haven't talked about, but a volume spike where prices have already moved up and we got that topping tail, which that's a bit of a warning sign there. But it resulted in a sideways move, so it all turns out to be bullish, and then wide range bar igniting and prices continuing to move higher, and that's a bit of a concern, that wide range bar after multiple bars moving up, which could be ending the move, and notice the big volume there. So a lot of stuff going on this chart. Now here is another scanning page of mine. And so what we're looking at here is my swing trading page. And I'm looking for stocks that are trending up and I'm trending down, and one in which there's been that volume surge on the day where I don't know what I'm going to find. So I just start clicking through that particular minder to see what's in it. So as I click on any of those symbols, it populates those charts and I view them like I've already explained to you. Is it going up? Is it going down? Consolidated? Is it pulling back into the 20 MA? Is it a W bottom? All of that. Now, within the minder, this MBT tells me that, and there's none of them here, in here, as we can see, but it tells me if it's basing, which means I'm going to find a base within an uptrend. I'm going to find whether I've got a stock that's near a 52-week high. Is it going to report earnings? What these are, I know you can't see them, but what this is telling me here, I've taken an indicator called ADX, which is a trend strength indicator. And I don't plot them on the chart because I'm not interested in that. I'm interested in this number. Right? So what this tells me is if I sort this list and I look for the ones with the highest number, those are going to be the ones with the strongest uptrends. And the lowest ones are going to be ones with the least strongest trends. Now, all of these are in strong trends because if it's above, say, 25, the trend is relatively strong. So that's a starting point. And I can sort this by high number or low number. What this is telling me here, this RSI, 8-period RSI, I'm not looking at it as overbought or oversold, but within this minder, what I can do by sorting this is how strong is the trend? And this gives me a starting point as to whether this number is high or low. So what I know, if I look at, I wish I could show you this, but AAP, what I'm seeing here is that 54 is a relatively strong trend. But this RSI being at 11 tells me that I should find a stock that's pulled back over a few days, whereas SEAS being at 72 and even a stronger trend has probably been moving up for several days. It doesn't mean I won't look at it, but notice that it is a 52-week high, which means odds are it should be able to go higher. So minders are powerful tools that help us move through the hundreds. You can see there's 249 stocks within that particular minder. So by sorting here, I can sort things through volume, price, and so on. And the same thing with ones that are in downtrends. And then these volume surges here, I sort this by percent change on the day and just look at the charts as to what are they telling me here. You know, in this case, this stock was bottoming out. It was at resistance. It's starting to turn up. We've got a nice wide range bar on volume, igniting a move and a bullish consolidation. You know, our moving averages just getting started here. So while it's up at resistance, it's telling me this would probably be a nice setup if it would pull back a little further to that 20 MA and give us a nice buy setup in anticipation that it could move higher from there. Now, as we go through these, I could do this virtually to the end of time going through these charts and explaining them to you, but obviously there is a time element here. But I'm going to explain to you what's good and what's bad, and I can continue to do that. But, reviewing this is going to help, of course. So, as it says, the goal here is to provide you with examples with my overview for you to review, and then you really should be doing this on your own. Even as I've already mentioned, you're recording yourself and going through the same process. It'll help you tremendously. So, let's say capture charts, mark them up with your comments. I printed them out for years doing that. And it was before there was really software to do the type of things that I've suggested you do with Microsoft OneNote. But, just printing out charts and marking them up, it's a great exercise. I already mentioned, make your own videos, teach somebody else. Capture your charts, keep a journal, Microsoft OneNote, mention it again. Right? I'm giving you the keys to success, and you want to pick them up. You want to utilize them. Obviously you do. Right? You've taken this course, and now you just have to put all of this together and start doing it. All right, you're going to come across charts just like this. What do you do with them? Basically, you move on. Just reviewing what's happened here. We've got this bearish wide range bar igniting a move to the downside, and it creates this void. You can see how the moving averages were pretty close together over here. So we've got the start of a move here, but this has created this void up above. So while I'm bearish on this, and notice that move up failed and how it failed over here with the topping tail. So what do we do here? Well, it can happen in a few ways. It could either set up an M-top, which creates support, and I like that kind of a pattern where maybe it pulls back a little bit and then comes back up, and it's created a resistance point up there, I should say, and that could give us a shorting opportunity. Sometimes these will move up into the 20, and it makes a higher low and a higher high. That also gives us a great setup to sell short, looking for prices to move lower. A more complex pattern would be a higher low, higher high, and it's a great pattern when it sets up, and then an M-top within this area, looking for prices to take out this low. Why would I look at to take out that low? Because of this big picture. Now here's a setup that could pull you in at bad timing, meaning you've got a red bar ignored and then a bottoming tail bar right there, which says it should continue to go higher. Of course, there's no denying that. But look at the distance between the moving averages and the moving averages in price. I do believe that this stock would eventually go higher, but as I look at this, it just doesn't look like this consolidation is mature enough. So there are positives here, meaning this long consolidation and the moving averages moving together. It would not pull back, which was bullish, and we got the red bar ignored. But as far as this being a continuation pattern, as I said, it better be a runner if you're going to put a stop under the bottoming tail bar, because that kind of a pattern could easily take out the low of that bottoming tail bar and really nothing be wrong. It could pull back to here where the 20 MA begins to catch up with prices. So you really have to decide what it is that you want to take and how aggressive you want to be. So if you were to take that, I would strongly suggest smaller shares and a bigger stop, looking for it to add, because it is a very attractive pattern based on what I said. And notice that volume and that professional gap up. It's a great setup suggesting higher prices, but is it ready right now for us to take a full position? I would say not. But there are ways to participate in it, and definitely to put it on a watch list, or if you're going to take a position, a bigger stop as mentioned. Here, prices have gotten a bit extended from the 20 and the moving averages from each other. So pullbacks to minor support would make sense, or to the 20 MA, which is actually what happened. So we did get a several bar pullback, And in this example here, we did talk in the multiple time frame section about wide range bars and looking inside of them. So if we were to kind of imagine this pullback that occurred from the high as multiple bars down being trending lower in a smaller time frame, and this is a daily chart, so which would be on an hourly time frame would be a downtrend, and notice the little topping tail failure there. But what makes this attractive is the fact that it traded under those 3 bars lows and then formed a bottoming tail bar. So another example of a move that started and a consolidation, and notice the volume spike there on the breakout, which is where you'd really want to be paying attention to this particular setup to get long above the high of that wide range bar. Even though it didn't close at the high, the setup is there. It's a pro gap. You've got the volume. It closed above that resistance. Great setup there. And then as you just, observe it bar by bar, the topping tail being ignored, the red bar being ignored. Of course, you'd be looking here to see what's to the left, a price void. So just continue to put it all together as we have been doing. Next setup here, right? We've got a great reversal at the beginning of a move up there at the highs. And excuse the green, but that's the color I had at the moment. But this big move down starts the move. Notice the moving average here. They're close to each other. And then prices push up into that resistance area. And then it attempts to move up. And it's what you kind of refer to as the market saying, I got you. Right? For those that would look to go long a situation like this. Why? I have no idea. But the moving averages are a guide that you shouldn't be thinking long, of course. You should be thinking looking for a short opportunity, and that breakout and then failure there gave you that opportunity. And this gives you a second setup right there into the 20 with the topping tail. You can see the little breakout failure that occurred there. And then you get this bottoming process that begins at that point. And, you got this upside shakeout. And I've already mentioned bottoming processes tend to be really whippy. But this could be the start. Since we've got this wide range bar here, I certainly would have liked to have seen more volume occur on something like that. But clearly it's a bottoming process. Now here's another short sale setup for a swing where you've got a crack. Right? Crack. You got a nasty move to the downside that slices right through all of the moving averages. They were already declining, as you could see. The 200 wasn't, but the 20 was under the 50, and they were both declining relatively close together. And then prices come up into that area that they broke down from, and look at the green bar followed by the engulfing bar. And you should have already been thinking short, whereas if it traded below these lows, it would have given you an opportunity. This price action that was going on here, I was in a swing trade here, that would really make me nervous. Now, while it would not have stopped us out based on what we've talked about here, this day-to-day price action, because it's in the area of that low, is really erratic there, and it's going to happen sometimes. Now, keeping your stop far enough away and not tightening it up too fast would have saved you in a scenario like that. But notice what happens when it clears that support point. The takeaway here is to recognize that now certainty has come in to this particular stock, meaning there's little doubt that it's not holding. And we can assume that there was a void below. And so you get this wide range bar starting to move down. There's no volume there, just per se. But nonetheless, it went down, and it went down lower highs, lower lows. And then when it gets extended from the 20 MA, it did begin to stabilize. And we say that there was a minor shakeout there, because that bottoming tail bar did click down underneath that, and that started a retracement. So I drew out this type of setup earlier where prices get extended and then you get a higher low and a higher high moving up into a resistance area. And then this M top is just such a high probability setup for several reasons, meaning you have a downtrend, right? So the trend is down. That's in your favor, and that's why we're only thinking sell here. And then as it comes up into this void, let's just clean that up a minute. As it comes into this void area here, it then creates resistance. So the odds are in our favor. We already would have looked to see what's over to the left over here, and this M top provides us a new setup. Now, if you miss that one, our method gives us another setup, and a great one, where you've got a retracement into minor resistance. I should say resistance, not support. Minor resistance, and you get a nice reversal there. And then it took a little while as this tried to hold this area, and when it failed, the same type of reaction here as there was here, and then the process starts all over again. 3-bar move from a base is the same as a wide range bar, right? Which is what happened as prices exploded out of this consolidation right over here. 3-bar move is the same as a wide range bar. We did get pretty good increase in volume there. And notice this rounding bottom here. Now we wouldn't have done anything with that, but it's something to take notice of, that it came down to the 200. It was a breakdown, and prices retraced all the way back up again. So I cannot tell you that we would have been able to take advantage of this, because it's just not a setup for us as a swing trade. However, we probably would have found this, not probably, we would have found this on the gap list, and it's still not a setup. But at this point, it is. Meaning it already happened. We're starting to get a pullback. It's happening where the move is just starting. Look at the alignment of the moving averages and how close they are to each other. And of course, you recognize this whole base that occurred there. So this rounding bottom gives you a setup. No doubt this was a concern, but it immediately begins to stabilize and move up again. So are you trailing prior bars lows? Which is okay. It moved up several days in a row. Why not? Now let it pivot and begin to bottom out again. And as it begins to accelerate, start trailing prior bars lows again. I gave 2 time frames here instead of just focusing on the daily. So we've got the weekly in the upper left there, and these green triangles correlate to the daily time frames, and you can see what's happening here. So we've got a weekly time frame that pushed higher and pulled back to the 20 MA. So we've got this nice move up over here and to the 20, and stabilization and a wide range bar starting to move up. And this is happening right there. And there's your volume spike as the move starts. And this was a nice little pullback there as the move just begins. Now looking at this from the daily time frame, this is a pretty deep retracement right here. But this is how higher time frames and multiple time frames really keep these deeper corrections in a perspective of saying, hey, you know what, this weekly chart, that's still bullish as hell, right? Look at the 20 MA, look at the price action here, right? The trend is up. The odds are that prices will continue to move higher. Now, I don't care for this as a buy setup to take from this time frame. I'd really rather to see things begin to tighten up. And sure, you're going to miss this kind of the move here, but if this had formed a W bottom, I'd be interested in that. But over here, where we're getting this 1, 2, 3 type of continuation pattern and its attempt to move down, remember the 50 MA is an institutionally focused moving average where they're going to buy or average in. And so you've got a move up from there, and that 1, 2, 3 pattern, while it doesn't have a complete void above, the odds are in our favor, and multiple time frames says that this is going to continue to move higher. So a lot of things coming together, and I could continue to show you perfect setups, but I choose not to, and show you things that are not quite perfect, but to understand what's happening here. And I think that's so much more beneficial than to just continue to show you textbook type of scenarios, and to really understand things as they can happen in the real world. All right, another weekly, daily time frame, and looking at this weekly chart, we've got a bottoming process, which you can see here. Right after the breakout that failed, that was certainly bearish on a weekly time frame, and this bottoming process then begins to repair the damage. So we really don't have any clean, clear setups here for our swing trade. Potentially right here, I would have certainly considered that at that point, because why would I consider that? Because we understand that that reversal there is the same as a bottoming tail bar. Right? You understand retracements and what they mean, and multiple time frames, and it's pulled back, and while it's a little breakdown on the daily time frame, this is bullish area, 1, 2, 3 type of continuation on the weekly time frame. This area, that is your rounding type of a bottom, your transition from red to green on the daily time frame, and a 1, 2, 3 continuation pattern in an area of support. Master traders put together all of the MT concepts. That's what forms a strategy. Trend, multiple time, say relative strength, relative weakness. We look at our price patterns and bar by bar analysis. That you market bias, what is the trends? What do your market internals say? A lot of times the market internals are neutral. Our focus there is when they're at extremes, bullish or bearish. Has the move just started? And we can tell that quite easily as it moves coming out of a base, the moving averages being our visual aid, or prices close to the moving averages, right? Everything that I've explained, right? And at this point, hopefully it's becoming repetitive, because that's my goal, right? To keep repeating this, to ingrain the information into you so that it becomes second nature. And lastly, has the move become extended? If prices are far from the moving averages and the moving averages are far apart, you know, if you're looking for longs, that there's an increased risk there. So what are we looking for? W bottom, some type of sideways consolidation into a rising 20, a pullback toward the 20, of course a pullback to minor support and the rising 20. Any combination of what I've said to provide us an opportunity for longs, and we just reverse the whole scenario for shorts. And we also, of course, always looking to see if there's some type of a price void. Now, if we're looking for longs and there's a prior swing high up above, take notice how far away it is, of course, but we always make the assumption that uptrend is more powerful than a prior swing high, and that swing high should be overcome. Now, that being said, when prices are very close to that swing high, meaning if you have an extended move and the retracement is extremely shallow, that's not going to be your greatest scenario for a buy. Look for longer consolidations, look for those pullbacks, because even though it's in an uptrend, your reference point of resistance is relatively far away, and as mentioned, anything can happen. So if we can get in near the moving average, near minor support, near major support, near created support, a W bottom, much better odds in our favor. So it's a lot to consider, granted, but as your eye becomes trained for what you're looking at, believe me, you're going to see this instantaneously. It just takes a little time where you just start looking through charts and looking through the scans and reviewing the MT lives that Dan and I do. You'll see how it comes together, and you'll be flipping through charts pretty soon. Our eyes are so trained for what we want to see that if it doesn't pop out and jump out at us as to, hey, that's an opportunity, we just continue to move on. And when you see the chart stop and we start staring, that means that there's something there. And you'll see soon enough, as you start to scan and looking through the information that I'm provided you right here, you'll be doing the same thing. So practice, and repetition, and you'll see soon enough, and it'll all come together. So let's move on to our next section. Well, we're in the home stretch here. We've made it to the last module. It's one of the most important ones, and maybe one of the most difficult to overcome because of human nature, but we need to think like a professional. So let's talk about that and what it takes to succeed and why most don't. So discipline, it's hard. Waiting for the best setups, that requires patience, but we know that they work. So why is it so hard to go and pick up the money, so to speak? It's about human nature. I want what I want when I want it. When it comes to the markets, and especially when you're doing this professionally for income and for a living especially, we don't feel like we're being productive if we don't have a trade on. And in some market environments, finding a great opportunity isn't so easy to do. So when that's the case, we don't trade because there's no point in risking our money. And it says, I can show you what's needed, but only you can do what it takes to make it work. And so let's talk about it. Well, what is the Holy Grail? And here's, a definition as it is in trading terms. It's looking for the perfect system, the perfect parameters, indicators, settings that are going to make money in any market environment that's easy to follow, that is going to work every time. And you know what? It's just not out there. And so many just take years searching for it because they've been inundated with this type of thinking, which we've talked about, the indicator-based methodology, about using indicators, trend lines, moving average crossovers, Fibonacci retracements, and even the more esoteric when you get into the Elliott wave scenarios and such. It's really looking for, as I said, that perfect setup where you'll never lose any money, guaranteed to win. It just doesn't exist. So accept what we're looking for and what I've explained, and a method of using multiple time frames, bar by bar analysis, support, resistance, relative strength and weakness, market internals, and the price patterns where all of that comes together. For me, that is the Holy Grail. I know that not everyone is going to work, and that's why money management is so important, in that while I have confidence in every pattern that I'm going to risk my money on, I accept the fact that not every single one is going to work, because if I was 100% sure that they'd work, why not use, directional options and put it all down, so to speak? It's not going to ever be that way. It's great when everything works out perfectly, as it does, but we have to be focused on the risk and then, of course, the reward. So that Holy Grail is all about self-management, money management, and trade management, which I've shared with you. So again, your job is going to be to put it together in your own plan, with your own rules and setups, and to follow that. That's the discipline and patience part. Why do they fail? Well, it's always the same thing: poor planning, no education, not treating it as a business, swinging for the fences, no discipline to control emotions, and emotions are difficult to control. We're all human. And part of the process of controlling emotions is to recognize getting emotional. So in a strong bull market advance, it does become where you're willing to put on more positions, and that, of course, that does make sense. But if you're not doing it intelligently, where the money management and calculated risks and everything we've talked about, it's not going to work, because when things change, and they can change fast at times, you can incur some big losses. So I just keep bringing you back to the money management part being such an integral part of success here. A lack of objectivity. Your ego is too big. Well, a lot of individuals that come to the market have been successful in another business, and maybe they got a bit of an attitude, but, the market will humble you, because, there's no guarantees, and, money management. Lack of persistence, laziness. They don't do the work. What does that mean? Well, don't scan. They just see a setup. They decide, I'm going to press the button on that. They don't keep their journal, tracking winners and losers. And, if you don't do the work, it's like anything else. You're not going to succeed. Your expectations exceed experience. Well, if you're taking this course, you may have a lot of experience, because I've had a lot of individuals come and get education that have been in the markets for a long time, but they've never approached it in a professional way, meaning getting an education, but they've been in the markets for a long time. And maybe they think that they're going to make a lot of money, but their experience and lack of education doesn't support that. Why does it happen? Human nature. Back to the same thing. Why do traders succeed? Well, they're prepared before they press that button. They have realistic expectations, clearly defined set of rules, rarely if ever break the rules. Well, let's be realistic here. Human nature being what it is, we're going to break rules sometimes. There are going to be patterns that set up that they look good. Maybe they're not perfect, but maybe the market environment being such that a lot of things have been working out, so we loosen up the rules a bit. That's going to happen. Probably plenty of times you're going to get away with it. If you know what you're doing and you're taking calculated risks, everything will be fine. When there's an opportunity, you take it, rather than continually second-guessing what's happening. Going back to the what-if situation. Well, if you had a plan and you understand the patterns, you're not going to be saying what if, because you understand what's happening, as explained. Multiple time frames, patterns, trends, so on and so forth. Once you're in the trade, you let the plan take you to profits, meaning money management, bar by bar, trail stops, pivots, and such. If you can't find an opportunity, you don't do anything, what we call SOH. You're sitting on your hands. You're doing nothing, because there's no reason to be placing trades for entertainment. We're not here to be entertained. We're here to make money. And if we find the good setups that are in alignment with what you've learned, the money will follow. They don't change their rules on the fly, meaning they're not deciding that, okay, based on such and such, I can now do something else. It's not the way it works, and we need that rigidity as to what we're going to do, because otherwise you're flying by the seat of your pants versus a trading plan, and in the long term that just doesn't work. And they're unwavering in their confidence and attitude. And part of the way you get there, honestly, is from losses and not following the rules. It's like putting your hand in the fire. And when it comes to the markets, for whatever reason, at the beginning, there's a high tendency to put your hand back in the fire because of the greed factor and the focus on the money versus the approach. So knowing that, I can't tell you that you're going to not put your hand back in the fire, but just being aware of it certainly helps to avoid that. Consistency. Well, profitability is not always about finding the perfect pattern. It's certainly the start. It's what we've been talking about in this whole course, but it's about consistency. As it says in regard to the trade and money management, once you've actually found the pattern. So through that consistency in your approach, execution, as it says, the money becomes a byproduct of you executing your plan with consistency. Why have a trading plan? I think you've gotten the point by now, but a big part of it is controlling your emotions, being objective versus relying on subjectivity and tips and just arbitrary beliefs as to why prices should go up or down. You're developing a robotic indifference to what's happening. Great to say that. The reality of it is none of us are ever going to be robotic, but starting with the theoretical is a starting point, and having a trading plan is definitely going to help us get to that point. And being prepared for all market conditions, you have the tools to do it. But everything that I've explained and the market internals that I've told you, I have used for decades, will certainly tell you when risk is rising for longs, and if it's a bear market where risk is rising for shorts, and when opportunity is rising as well. To build consistency and faith in your plan can only come through experience. So once you've gotten an education, experience follows, and your confidence in your consistency to follow through builds. It's simple, but not easy to do. But you've got the information to do it. You're going to develop and document your approach to the market. So you'll measure your performance to see how you're doing. You'll make refinements. This is about keeping your journal, and it keeps you focused. What's the task at hand? Following the plan, and of course, in turn, making money. Right? As I said, the money is the byproduct of following the plan. So your plan should always have an answer, meaning if this happens, what am I going to do? So once you've gotten to the point of here's the pattern, and I've looked at the broader markets, and I'm ready to execute the trade, well, you've got your stop loss. So there's part of the answer. If it doesn't work, I know what I'm going to do. My money management has provided an answer as to how much money I'm going to lose. Now, as a swing trader, we're taking that overnight risk, so gaps can occur. It'll happen, but being aware of earnings, economic reports, and maybe Fed announcements, all of those things help us to avoid risk that is avoidable. So if there isn't an answer, you sit on your hands, you do nothing. Keys to success. I know I'm repeating here, but we've repeated a lot through this course about the repetition of continually reinforcing what works. And that, in this case, the trading plan. If you don't have one, well, almost certainty guarantee failure. I think it's probably close to 100%. You might get lucky now and then, but from a long-term point of view, without a plan, I think it's a guarantee that you're going to fail. And that trading plan is your success key. So obviously, make one. And then making that plan, a lot of traders, they just don't spend much time on follow-up. Again, this is a job, meaning, look, if you want to make money consistently, you're tracking your trades, you're doing your scans, you're finding the high-quality setups, as we've discussed, you're placing the trades, you've got your stop losses in, and you're following the rules. So there are a lot of things to be reviewed and learned, but you have the information to build on. Patience and discipline to follow your plan and method is the success key. And I know from experience, I've been doing this for a long time, that it's the last area that most conquer, even after hearing about it. Why is that the case? It's human nature, and we all follow the same path. Those that are educated get to their goals a lot faster. It's the same as any other business. This one is definitely tougher because of the human nature factor, but you can do it. You've got the information here to do it, so you just do it. Just do it. Losing streaks. Let's talk about that a little bit. Well, most of the time, once you've got your trading plan and consistency in what you're doing, losing streaks happen because of a changing market environment where patterns begin to fail. Even while you've got the tools, as explained in your market internals, things don't necessarily turn on a dime, and you're going to see good setups that will fail at that turning point. And the money management part is going to take care of that. But after several bad trades in a row, maybe you're missing something, right? So stop trading. Reevaluate, review your trades in your journal. Look at those winners and losers. You're going to see some recognizable patterns, and you'll say, "Oh, I was chasing, or things were near resistance." You're going to find what it is that you were doing wrong, or maybe it's just a bad market where it's changed. So it just comes with being in the market. But anyway, you're going to eliminate poor quality trades, get in a positive state of mind, review your list of demons, whatever it is that you've been consistently doing wrong for whatever reason, right? Review it and stop. Paper trade as if it was real money, meaning don't just take trades or say you're taking trades because it's not real money. Approach it from a real money point of view. Develop consistency with smaller share size. I even mentioned $10 when we went through the money management part. Whatever is relative to you, whatever you're going to keep that maximum exposure to, make it virtually indifferent and focus on executing the plan until you have those 3-to-1 winners again. Be selective, as you always should be, about the trades based on what you've learned. Review the material in this class. The answers are here. And again, through repetition, it becomes ingrained to you as to what you're looking at. The great setups, I've explained them to you. You'll see them as they begin to form. And you'll place the trade with money management rules, and you'll manage them accordingly. And things will work out in the long run if you follow what you've learned. So at this point, you've got great information to build on as a master trader. It's up to you to do all the work. Internalize this material. As I said, make it yours. And that's what it has to be, to where you've incorporated this into your plan, into your style of trade, into the type of stocks that you want to trade. I've mentioned I don't trade biotech stocks because I'm not willing to assume the risk. The upside is very attractive, but I won't assume the risk. Maybe you will. I mean, I kind of think about all the traders that I've maybe not necessarily met today, because a lot of things happen over the internet. But in our trading room, I can think of one trader that is always mentioning biotech stocks. And of course, he's had good experiences there and made good money, or he wouldn't be doing it, and maybe hasn't been bit by the bad news situation. I can't tell you, I've experienced the bad news situation personally in a biotech stock. I've experienced it in other stocks, 2 of them that come to mind. I don't remember the symbols, but they happened because I didn't check earnings and got caught and gapped down. So that pain definitely reinforces following the rules. Now, as far as biotech stocks, I've seen many of them gap down 50%. So I just don't want any part of it, even though the upside is there. We define opportunities because there really are no secrets. It's about putting the odds in your favor and having the discipline to follow your trading and money management rules. None of us know the future. Once that new bar starts to form, we have to be open to what happens. Tools I've provided you are going to tell you what is happening, won't necessarily going to tell you what's going to happen tomorrow or next week. But with an objective approach to the markets and money management, you should have confidence in what you're doing. You've got an objective approach, and then see what's going to happen. So going forward, it's about Master Trader and you building your financial future. All the best. If you have questions, of course, email me, and I will see you in coaching, where we will review and you will ask questions, and we will work toward ingraining this information and making it yours. And the end goal, of course, is making money. All the best. Good luck, and we'll talk soon.